Alright, before I start this video, I need you to picture something genuinely strange. Somewhere right now, a hedge fund manager is looking at a company that is circling drain. Its sales is falling, there is mountains of debt, and lawyers, they are on speed dial. And instead of running away, the hedge funds manager are wiring money to buy that company's debt. But why would anyone do that? Why would anyone want to own a debt that the entire market has decided is worthless? Right? So stick with me, and by the end of this video, you are going to understand one of the most misunderstood and honestly one of the most profitable corners of finance. This is distressed debt investing, right? And trust me, it gets weirder and smarter than it sounds, right? So imagine a company that owes 1000 crore rupees. Now the problem is that the sales of that company is falling, debt is eventually piling up, and the company is on the verge of bankruptcy, right? And the bonds that they issued at the face value of 100 rupees are now trading at 30 rupees. That's strange, right? And at this particular time, what most investors would do is they would run away, right? But when we are talking about distressed debt investors, they are basically running towards it, right? But again, the question, why would anyone buy the debt of a falling company? Their thinking is, in distressed investing, disaster is often considered to be an opportunity. And we'll see how and why they see it that way. As far as our videos go, we first and always start with the basics, right? So understanding what bond really is, simply it's just a promise to repay. A bond is basically a sheet of paper which tells you the face value, the coupon rate, which is basically in the interest rate, and the maturity. It's basically saying you in simple terms that I am making you a promise that I'll repay the money that you lent me, right? So it's simple. The loan amount of the face value would be 1000 rupees, the interest rate would be 10%, and you would be expected to get a repayment of 1100 rupees, right? As simple as that. But what if that promise becomes uncertain? What if the market is telling you that there might be a slight chance that you might never see that money, right? See what could happen when we're talking about a healthy company. Let's say we have calculated the repayment probability, and that comes out to be 95, and it's pretty good, right? It's pretty good. So bond price would ideally be traded at the same face value, that is 100 rupees, right? And everything looks fine, right? Be sure of one thing, the bond prices is actually sensitive to the external interest rate as well, right? We are not considering that possibility currently, just so that we can understand about the distressed investors. So the bond prices can actually change, they are sensitive towards the interest rates as well, right? But thinking about the repayment probability, which is at 95%, the bond prices should stay stable, right? Now what if you start hearing about the company that there is some or the other issue which is going on in the company, right? The market would get nervous, right? What will happen, as the confidence decreases, the price decreases as well, right? Now the same bond would be traded for 70 rupees, and let's say you actually figure out that this was not actually a very small problem but a big one. So market would react violently, right? And what will happen, the prices would be pushed down to 40 rupees, right? Because the repayment probability is quite low now, right? So the debt never really changed. The debt was in all scenario this 100 rupees, right? But the expectation of the market depending on the news related to the company has changed is trading price. The face value depicts the actual debt that was taken, and the tradable value basically tells you about the confidence that the market has towards that company's repayment capabilities and the repayment probability. Now, what would a normal investor say? See, it's under significant distress. I have already invested 100 rupees, right? What should I do? Is I should make sure that even if I'm getting 40 rupees for that, I should at least save my capital 40%. I'm getting 40 paisa on my rupee today, and rather than I'm getting 0 rupees, it's better, right? So they start to sell, right? And considering that environment situation, it is basically a fair assumption and a question, but it's actually incomplete. See, what would a distressed investor do is they would ask a very very important question. See, this is the question that is actually framing the entire concept. How much is already priced in? Now, what do you mean by that? This complete sentence is basically where the opportunity actually begins. I'll tell you with the example. See, what is happening? The face value is 100 rupees, but the market price is 30 rupees. But you have to understand there is something that is going beyond these two numbers as well. What is actually happening? Even if the company files for bankruptcy, what will happen is the assets of those particular companies would be sold. When the assets would be sold and the cash would be in the company's hand, their first job would be to pay off the creditors, right? We'll understand how the money moves in times of distress, but everything would be focused on making sure that all the creditors are paid off before the shareholders, before the other stakeholders. Creditors are given utmost importance, right? So let's say they sold off their entire assets, whatever they had, building, land, machinery, equipments, everything. So with that you can calculate the recovery value, right? This is the number that we actually miss to understand, right? So what will happen is, if you come across a company which is dealing in distress, and it had a face value of 100 rupees and the market price was 30 rupees, you can go back and check what would be the recovery value. So you can buy at 30 and you will get 50 out of it, so you will gain 20 rupees. That is a 66% return, right? So you'll gain 20 rupees, you invested 30 rupees, and that's 66% return. And that's actually a pretty good return, right? You're actually benefiting from when the company is dying. So distressed investors don't necessarily bet on survival. See, if the company survives, you are buying the bond at 30 rupees and you are getting 100 rupees back, it's a very good thing. But their main goal is just to take advantage of the adverse situation that has been created. They are basically betting on that the market is too pessimistic. See, the recovery value was 50 rupees. So ideally the market price should revolve around 50. But the market panics so much that is pushed the stock so below to 30. Right? The market here was too pessimistic. And that's why I said the most important question for this entire concept is how much is already priced in. Right? So their first thought of belief is that market is too pessimistic, they are too negative about everything, it reacts violently. You can see with the example here, right? So if the company fails, see, in this particular scenario the company is facing bankruptcy, that's why they are selling their assets, and that's where the recovery value would come from, right? The company has filed for bankruptcy and they have sold off their assets, right? So the company actually did fail, but they still earn money, right? But there are, again, we have to consider various scenarios to basically understand the scope of this particular concept, right? Let's say the market actually overreacts, that we understood in the previous example. Let's say you bought at the CMP, the current market price of 25 rupees, and the recovery was 60. The profit of 35 makes you the owner of a 140% return, right? But the market could be correct as well. At the CMP of 40 rupees with a recovery of 40 rupees, you'll end up with profit of 0, which is actually no loss, no gain. You're barely breaking even, right? Given there are no transaction costs and etc. Right? When we're talking about when market actually underestimates what kind of trouble the company actually is in, right? The bond will still trade at 40 rupees, but the recovery would only be 20 rupees, because markets actually underestimated how deep the company has fallen, right? So you actually end up with a loss of 20 rupees, which is 50% gone, right? So the core formula to understand and make sure that you are getting the expected value as sure is understanding about the probability of default. You multiply it by the recovery value and then you subtract the purchase price, right? Distressed investors spend their life estimating recovering values, and this is a very tough thing to do, right? How much actually cash will be generated when the situation is so complex, right? And now this is very important. See, when we are talking about distressed investors, they are running towards debt. They're not going in the market and buying shares of that particular company, and there is a very good reason for that. The reason for that is the common equity are often the last. See, whenever the company is liquidated, we have to make sure that all the creditors are taken care of. So first, we have divided them into tranches of who gets their payment first. So first of all, with all the cash flows that has come, maybe less, maybe more, maybe some percentage of what they have given to us, we have to make sure that first in line, which are secured debts, are taken care of. Then we have the high priority, which are senior debt. Then we have junior debt. Then we have preferred equity. See, this is basically a hybrid, right? It is equity, but you get preference, right? First, you will get paid before the common equity, right? If anything is left even after preferred equity, then and then only common equity people gets the benefit. You can see this real world live example with what is happening with JAL, right? The equity shareholders are not getting anything out of it, right? So this is why distressed investors often prefer debt over stock. They are not running towards buying cheap stocks, they are running towards debt. And there is something hidden in debt as well. What debt gives you is an invitation to the control game. See, what is happening is, when you are buying majority of the debt, you can become the largest creditor. We are talking about large scale. You're not buying one or two or maybe three, maybe 10, maybe 100. You're buying a significant portion of the debt that the company owns, right? So because you're a creditor, you're a very important stakeholder at that particular time when the company is going through bankruptcy. So your decisions, your voice would actually matter, and this would eventually influence the restructuring, right? And you could actually in real life potentially own that particular company if things go the right way, right? Because you are the majority creditor, right? You're the largest. So some investors basically buy debt for interest. They don't buy for interest, I'm sorry, they don't really buy for interest, but they are buying so they can have a point to be made at the table. Now, to understand this, Marvel is an excellent case. In 1990s, Marvel literally filed for bankruptcy, right? The many investors in the market totally believed that the company was absolutely finished, right? But some people were able to see things beyond just the numbers. They were able to understand the brand value that Marvel had. the intellectual property, the IP rights that Marvel had, and the characters that Marvel had. And this was actually a hidden value. See, when we are talking about case studies in my video, I don't exactly tell you all the story from start to end. With my what my intention with these videos is to make you understand, when you are understanding and reading about a case study, which all factors you need to understand and make sure you notice them. See, I can tell you the story and this video could be as long as 2 hours, right? And my point with these videos is not telling you about the stories that happened, but what you can learn from these stories. So after understanding what actually happened, you can actually go read the case study, and then you'll be able to pick up on the informations that I have discussed in a summary format, right? So what happened in this situation, because there was a actual hidden value in the organization, so distress, what happened actually never really ended up in destruction. Distress is not equal to destruction. It is a maybe the last tranche that could actually help you, right? And we have another case about Delphi Automotive as well. See, what happened was, see, there was problems with Delphi Automotive. There were definitely problems with it, but the assets, the factories, the customers, and the industrial importance that that particular American manufacturing unit had, it had real value. Like the Marvel, it had brand IP characters like Marvel had. It actually had a pretty solid variety of asset, factories, customer, and industrial importance. Right? There were problems. It had problems, but they also had real value. So the main goal of distressed investors is to make sure that they understand the underlying value and not the headline. When you are a serious distressed investor, you are making sure that you have enough debt on the company to make sure that you have a say at the table, right? And you can make decisions about that on the table. When you are actually the one who is influencing the decision at such a troublesome period, knowing the real value could actually help the company move towards a better direction, right? And see, so how do we basically do this entire thing? First, we identify distress companies, right? Then what we do is actually straight away end up going to understand how much recovery could be done. We can come up with a number. Then we buy debt cheap. Only and only when we are sure about the recovery. See, you can't be 100% sure, but you should be confident. Of course, you can't be sure that this is definitely what you will be getting, but you can be confident about it, right? And then understanding the difference between recovery and the market price, you can make a decision to buy debt, right? Then you can also influence restructuring. When you are estimating recovery, you can also consider understanding about the real value that particular company has. And then after influencing restructuring, then and only you can actually profit from recovery, or maybe lead the organization into another useful direction. The best distressed investors aren't really gamblers, they are just valuation experts. They actually know how to value a company based on a distressed environment and on a stable earning and real value as well, right? See, at the micro level, the borrower is struggling, right? At the meso level, when creditors come in, they negotiate and take it to the other direction, or influence the decision, or make it in a smooth entry. At the macro level, businesses could actually survive that hit or maybe disappear. But whatever happens should be made with a pretty confident or accurate decision, right? So market ends up panicking, which leads to debt prices being collapsed. Then we study the recovery value. Then we purchase debt for cheap. Restructuring happens, and the profit is earned. And this basic synthesis could actually help you make other people understand about distress investing in a simple terms, right? Market is panicking. When the market panics, it is reflected on the debt prices. Then you go and study the recovery value. Then with the informed decision, you understand what is the price of that particular debt in the market, and then you buy it for cheap, and then you take part in restructuring, and then you earn your profit, right? So they're asking whether the things are worse than reality or not, right? It's not about not buying failure. It's only about making sure you are understanding why and how this particular debt is mispriced, right? You have to understand when is market overestimating, or maybe let's say they are overly making things worse. They are too pessimistic about it, right? So if there is one thing I want you to walk away with today, is that in distressed investing, the biggest opportunities often hide inside the biggest problems, right? Because sometimes the debt recovers, sometimes the company survives, and maybe they can come back stronger than ever. And like Marvel, the investor could end up owning the entire businesses as well, right? So if you enjoyed peeling back this hidden corner of finance, hit subscribe, because we are going to keep exploring places where risk, valuation, opportunities collide. And I'll wait to see you in the next one. Thank you.